Now, recall that the accounting for a lessor has not changed. A lessor still classifies a lease as a finance lease or as an operating lease. Therefore, this makes the accounting for modifications by a lessor slightly more complex. Let's take a few minutes to discuss the accounting by a lessor. The lessor has to first assess whether the lease that is subject to the modification is a finance lease in the books of the lessor or is an operating lease in the books of the lessor. If the lease is an operating lease, then after the modification, the lease is considered to be a new lease. What it means is that let us suppose a lessor used to charge 10,000 rupees of rent every year and had an escalation of 5% every 2 years. In this case, the lessor would have calculated the amounts post escalation and would have worked out a straight line amount to be recognized as lease rental income. This would have also created a lease equalization reserve in the books of the lessor. What the accounting guidance states is, in such a situation, if the original lease was an operating lease and there is a modification to that operating lease, what you would need to do is take out all the new cash inflows under the revised terms and adjust the lease equalization amount. So if you had a lease equalization reserve of 5,000 that was outstanding in the books on the date of the modification, and the summation of future lease rentals was 50,000, on a straight line basis, you would recognize 50,000 less 5,000. So you would only straight line 45,000 over the remaining lease term. And that's how the accounting by an operating lease happens for a lessor where there is a modification. Straightforward to understand, again, practically cumbersome, but at the end of the day, the standard has not given any relief to a lessor. So any lessors, if you are going to be someone who is giving a benefit to your customer by way of a reduced consideration, you will need to track what is the lease equalization reserves in your book and adjust that to arrive at the future lease income that you will earn in the books. Nothing else changes from an operating lease standpoint from a lessor's perspective. Let's turn our attention to the modification accounting by a lessor, where the subject matter of the lease is a finance lease. Once again, we'll go through the same flow. After the modification, is the scope of the asset increasing? If the scope of the asset is increasing and the increase is at a rental which is then prevailing in the market, then you account for it as a separate lease. Once again, a fairly straightforward scenario. On the date of the modification, if you are going to add one more floor in the leasing arrangement and you conclude the lease rental and charging is the market rental, you will now discount all the minimum lease payments at the rate implicit in the lease. And because this is also a finance lease, you will de-recognize your asset in the books from property, plant and equipment or investment property and recognize a finance lease receivable, which is a financial asset in the financial statements. Because it's as a lessor, if significant risks and rewards are transferred, we would have always been used to de-recognizing the asset and recognizing a receivable. That continues even in the current situation. Again, what would change is the discount rate for the MLP would be the discount rate prevailing on the date of the modification. In other cases where the scope of the asset is reducing or the consideration is reducing, the standard requires us to go back to the day of inception of the original lease and assess as to whether on that date, had I applied the new terms, would my classification have been an operating lease or a finance lease? So let us suppose that I started off with a finance lease on day one. 2 years later, I changed the terms. I changed the lease rental. The standard takes me back to the date of commencement of the lease or inception of the lease and tells me if you would have applied the new rental throughout the lease term, would your assessment have been that it continues to be a finance lease or would it have been an operating lease? If you conclude that no, with the revised terms, if I had known them on day one, and this is important, where at inception, if it would have been an operating lease, then you now have a new operating lease. So what you would do is you would de-recognize the finance lease receivable and recognize a property, plant and equipment or an investment property back in the books of accounts. Because you are saying it's no longer a finance lease, I now have an operating lease. So if you have an operating lease, the asset comes back on the books, the financial asset gets de-recognized. Alternatively, if you concluded that no, even after the change, my finance lease continues to remain to be a finance lease, that is when you apply the guidance under Ind AS 109 that deals with a modification of lease. And to spend a quick 1 minute on what the modification guidance under Ind AS talks about for a financial asset is it says, please assess if the modification is a substantial modification or not. A substantial modification arises out of qualitative changes to the agreement or quantitative changes to the agreement which are greater than 10% of the carrying value before the modification. If either of these two conditions are met, you de-recognize the old lease receivable that you had in the books and recognize a fresh financial asset for the lease receivable. Any difference in that flows through the P&L. On the other hand, if the modification is not substantive, then you recognize this transaction by adjusting the EIR. So once again, friends, interplay between multiple accounting standards for a lessor. Important to keep in mind that each of these situations could practically impact, again, whether you end up with a property, plant and equipment back on your books, if you have a financial instrument, de-recognition of a financial instrument. If of course your new lease is a finance lease, then you have one more finance lease to deal with. So little more complications if you talk about it from the standpoint of a lessor, for the simple reason that a lessor has a dual model of a finance lease or an operating lease. And let's once again look at a couple of examples to